Hello, everyone. My name is William Mucker. I am a client executive with Camoplan, and I would like to thank you all for joining us for today's webinar, Profit with Purpose, the compelling case for investing in affordable housing with Ron Lockhart and Peter Neal of GSP REI. As a quick note, please be aware that Ron and Peter will be answering questions at the end of the presentation. However, feel free to use the chat and/or Q&A function on your screen to pose your questions whenever they cross your mind. They will be saved and addressed once the presentation portion ends and the Q&A portion begins. Before we get started, we do have a brief disclosure to go through. Everything presented in today's webinar is strictly for educational purposes. Camoplan is a neutral third-party administrator of IRAs. We are not attorneys, CPAs, or financial advisors. If it comes to a time where you need advice in any one of those fields, we highly recommend you consult with your team of professionals. We are more than happy to be a part of a dialogue with your team of professionals to ensure that the investment process is quick and seamless. We do not sell any investments at Camoplan, nor do we endorse any products. We will never call you about the next best investment opportunity. We believe that you should always do your own due diligence before investing your money, whether it be your retirement funds or otherwise. Once you have found the investment that is right for you, we will help you open your account, fund that account, and facilitate the transaction into that investment. Here is my contact information. If you or anyone that you know who you believe can benefit from the information have any questions about what is discussed in the presentation today and how it applies to self-direction, please do not hesitate to contact me. I would be more than happy to help. And without further ado, I'll pass the controls over to you.
All right, let me share my screen here. Hold on one second. Okay. My dog picked the perfect time to come in the room and get the pets. All right, Will, I appreciate the intro there, and I thank everybody for coming today. So, like Will said, profit with purpose, the compelling case for investing in affordable housing. That's the topic for today. Hopefully you walk out of this, better understanding affordable housing and the opportunities that are available, and understand that there is an opportunity to make a profit with a greater purpose when it comes to investing in affordable housing. So let's get started. So my name is Peter Neal. I just want to start by saying, thank you to Will for having us on, and thank you for everybody for taking time out of your day to listen to us. And anybody who's listening to the recording, I appreciate you taking time out of your day to listen. So over 9 years of real estate investing experience. I started in note investing, transitioned into, still doing note investing, but also, rental properties, fix and flips. My background is in raising private capital and fund management. My partner, Ron, is with us today. Ron brings over 20 years of real estate investing and construction experience to the table. He has a background in residential building, construction, property management, and real estate financing. So we are the co-founders of GSP REI, which is a vertically integrated, technology-driven real estate investment company. We specialize in single-family affordable rentals throughout Pennsylvania, Maryland, and New Jersey. We're based in Paoli, PA, so just a suburb of Philadelphia. We work with local real estate professionals, government-sponsored enterprises, also known as GSEs, and financial institutions to acquire discounted real estate and distressed loan portfolios and individual assets. And our investment philosophy is pretty simple. We want to earn a high rate of return for our investors with as little risk as possible, and that is achieved through our vertically integrated structure, meaning in-house construction and property management, as well as a lot of the other stuff that we're going to be talking about today. So what are we talking about? So affordable housing. So let's get out of the way, what is affordable housing? So HUD, the Department of Housing and Urban Development, defines affordable housing as housing that requires less than 30% of the occupant's gross monthly income. So think about that, less than 30% of the occupant's gross monthly income. Affordable housing, another way to look at it is it's a critical component of any thriving community. It's aimed at ensuring individuals and families have access to decent, safe, and affordable homes. So there's a lot of different types of affordable housing. These are just a few, and there's also different opportunities within the affordable housing space. So, like I said, we cover affordable housing rentals, but there's also opportunity within the business from wholesaling to fix and flips to notes, private lending, fund investing, land, apartments. There's a lot that goes into the business. But just to kind of break down a few different types. So there's low income housing that targets individuals with the lowest income. There's kind of two ways to look at that. There's low income and then there's extremely low income. So low income is typically under 50% of the area's median income, and extremely low income is no more than 30%. And then you have like moderate income, which is 80%, just to give you some perspective. Workforce housing, which aims at essential workers, middle income households, people who they typically make too much money to qualify for low income housing benefits, and subsidies, but they're still struggling with housing affordability. Section 8 housing, probably something you've heard of. And a lot of times when people talk about affordable housing, they're talking about Section 8. That's a federal program that provides rental assistance, vouchers to eligible low-income individuals and families. And then on the apartment side of things, you'll see mixed-use developments, which are projects that combine affordable and market rate units together in the same building. It promotes economic diversity and inclusion. So why should you invest in affordable housing? So today we're going to talk about the four main reasons to invest in affordable housing. Essentially what it boils down to is profit with a purpose. So we're going to show how investing in affordable housing can be extremely profitable, and there's a greater purpose when it comes to helping, underserved communities, maybe communities that are local to you, and then the individuals and the families and businesses in those communities. And then we're going to discuss the risk and reward. So obviously with any type of reward, there's going to be risk associated. Fortunately, there are things that you can do to help them mitigate those risks, and we're going to be discussing those later today. So let's get right into it. Number one is increasing nationwide demand. So these are the four top reasons to invest in affordable housing. Number one, increasing nationwide demand. The demand for affordable housing in the United States has reached critical levels, and it's continuing to rise. If you look at the data, it's only getting worse. It's not getting better. And although there's been a ton of programs and incentives created from a state, local, national, federal level, those numbers are just increasing, and we'll speak to that in a couple bullet points here. So some of the data that I'm using is from Nuveen, which is they're the asset management division of Teachers Insurance and Annuity. TIAA is what you might recognize. They have over $1 trillion in assets under management, and they manage a $6.4 billion affordable housing portfolio. So they put out a lot of reports and data on the space. So that's where a lot of this data is coming from. So per their data, they say nearly half of all U.S. renters are considered rent burdened, meaning they're allocating more than 30% of their income towards rent payments. Even more concerning is the fact that 1 in 4 of those rent burdened individuals are what they deem as severely rent burdened, meaning they're spending over 50% of their income on rent. To look at it in another way, the National Low Income Housing Coalition, they estimate that the nation faces a shortage of 7.3 million rental homes that are both affordable and available to extremely low income renters. So that equates to, for every 100 households that are in that income bracket, there's only 33 affordable and available rental homes that exist. So to kind of give some idea into the demand and the scarcity of affordable and available product in that space. And that's just for extremely low income renters. That's for the people who are making, under 30% of the area's median income. That doesn't even factor in, your rent burdened or the severely rent burdened. And those numbers, like I said, if you look at the data, that 7.3 number is recent in the last year or two. It's gone up over the years. And this is a shortage that persists all across the country. It's in every state. It's in every major metropolitan area. But it's not just urban and cities, it's suburban as well, kind of spans the spectrum. So number two, the affordable housing provides a favorable yield stability throughout the entire economic cycle, which includes recession. So per Nuveen study, when they looked at traditional real estate sectors, that's office, industrial, retail, market rate apartments, affordable housing generally delivered higher yields throughout the last 20 years. Why is that? There's a tendency to avoid downward rent adjustment during recession. The scarcity for affordable housing options creates overwhelming demand, which leads to higher occupancy rates, which just all over, causes for less volatility when it comes to rent collections and things like that. So let's get into number three, because it kind of plays off of, why there's stability throughout the entire economic cycle. One of the massive benefits to investing in affordable housing is the access to government subsidies. So subsidies provide the property owners with stable and predictable rent collections, since the government is the one making the rent payment directly to the owner on behalf of an eligible tenant. So that reduces risk. It enhances the cash flow reliability and obviously adds a certain layer of security. So having a portion or all of the rent backed by government subsidies certainly provides a certain level of predictability and stability when it comes to rent collections. And number four, alignment with public and private social impact investing goals. So there's a lot of positive impact on the community in various ways when a community has an abundance or access to at least affordable housing. Studies show that it reduces homelessness. It creates more economic growth. One thing I mentioned to Ron when we were going over this was, one thing we've noticed over the years is a lot of our properties tend to be around hospitals, because there's a lot of people working in hospitals at different levels, from nurses to staff to people who do laundry or cooking, or, there's a lot of different jobs within a hospital, and it creates for a need for affordable and workforce type housing around those areas. There's community integration. So mixed income developments foster a sense of community. It reduces economic segregation. And then access to housing studies also show improved health and education. So there's a push from state, local, federal, and then the private sector as well, through nonprofits and other organizations that want to see the creation of more affordable housing, and they're trying to incentivize investors to create and bring more available units to market. Not to say that there isn't red tape and a lot of things that go into operating within the space, but there certainly is an alignment in this investment strategy compared to some others when it comes to just social impact investing goals from a government and from a private level. So here's a bonus reason. One thing that's good about affordable housing, if you're getting started and from a diversification perspective, is there's a low financial barrier to entry. You can diversify, usually these properties, at least for us, it could be different in your area. They're typically going to be under $250,000 in after repair value. And typically you're going to be buying, value add or distressed properties. So you don't need a ton of capital to get started in this space. And that also, like I said, it allows for greater diversification over many properties and in different areas as well. And there's benefits to that. So with a low financial barrier to entry, there also comes some other things you want to factor in. So competition. One good thing is there's a lot of misconceptions around investing in affordable housing when it comes to the areas, when it comes to the tenants. Everybody probably knows somebody who ventured into affordable housing investing and has a negative thing to say about it because they had a bad experience. And that kind of leads to the but when it comes to low financial barrier entry, but there's a high barrier to success. Now, fortunately, there are things you can do that we're going to discuss to help increase your chances of success. But before we get into that, no, this is going to be, let's just get right into that. So how to be successful investing in affordable housing. So Ron's going to help me with this slide. Ron, we kind of starts with knowing your market. So talk to us a little bit about how an investor can get to know their market, especially from an affordable housing perspective.
Sure. And first of all, thank you for having us on. I know Peter mentioned that earlier. And he touched on my background. I've been in this space for over 20 years. And I've touched about just every piece of the residential real estate marketplace as a whole. So when we look at markets, you need to start with your research first and find out where the demand is. And there's a tremendous amount of information available online. HUD has information. And once you understand where the need is, where the demand is, which, quite frankly, as Peter mentioned earlier, is nationwide, you want to learn more about the market you're focused on. And I think you have to first start with, what are your accessibility? You don't want to think about a market that's on the other side of the country. You want to think about a market that's close to you, where you can look, touch, and feel, and put together a team that's going to help you have success. So once you do that and you establish the need and you look at what the market, do your market research, look at what the different rental income is, acquisition prices, values, on and on and on. Talking to real estate professionals, whether it be attorneys who work for the local housing authorities, they're going to help you identify areas in the market. Talking to real estate agents are going to help you as well. So when you're talking about a market standpoint, from a market standpoint, we typically take 6 months to a year to research a market before we even make an investment, because we want to fully understand what's going on there. We want to see what's been happening over that 6 to 12 month period. Are we seeing anomalies in the market, or are we seeing established trends? And you can certainly go back beyond that and look further back in time based upon information that's available, again, through multiple listing services, HUD. There's a number of avenues. Once we've done that, we start to look at our acquisitions. And for us, we do all of, as Peter mentioned earlier, we're vertically integrated. We do everything internally. We have our own acquisitions team, and we have a number of different avenues that we utilize to acquire the assets. We use auction houses, GSEs, we use realtors, we use attorneys. We're looking for any opportunities where we can create value. For us in particular, we typically look to full renovation properties. It doesn't mean that we don't acquire value add properties as well. But when we're looking at entering a market and being in there for a prolonged period of time, we're not talking about 2, 3, 4 years. We hope to be in there for 5, 10, 15 plus years. So for us, having the next piece of this, which is in-house construction, we want to make sure that we're taking all the necessary steps, that we're not going to have a lot of maintenance issues going forward. So, and what we found through time is that, the best way to do that is full renovations of properties. Everything's brand new. If everything is being done correctly, quality control, that's something that you should be preventative. It doesn't mean that you're not going to have your issues. You're always going to have issues when you're doing something with scale. So, acquisitions, you need to buy right. So again, that ties back to your market research. Construction, make sure that your construction budgets are meeting your goals to be into the property for the right dollar amount and create the right type of equity. Because eventually, if you're doing this again on any scale or just a one-off property, I'm sure you're going to want to be refinancing and utilizing that capital elsewhere. When it comes to leasing, especially in a, scattered site, single family portfolio, you want to have a quality leasing team. So that involves internal and external. We utilize realtors in various markets that we've vetted and that know the market and the specific asset class that we're investing in, and they have experience with those tenants. Our property management's in-house, so that kind of ties into our in-house leasing component of this. Those people work hand in hand with the realtors when we're going through the leasing process, making sure that we have the proper tenant. A lot of times you'll hear people talk about the negatives of affordable housing and the type of tenant that you may have. I've said this for years. You can make an argument for that you could make that same argument for every asset class in single family, whether it be affordable housing, middle market, or high end. And I've owned and managed single family rentals in all those markets. And I can tell you unequivocally, I've had an equal amount of problems with high net worth renters as I've had with affordable housing renters. And what I would tell you is the most important thing is having a process in place that you're properly vetting your tenants to make sure that you're reducing the risk as much as possible, that you're not going to have issues or defaulting renters or anything else for that matter. And I really do believe you stick to that process, you develop that process, you're going to mitigate the risk and you're going to have a lot less problems. It's not just taking the first tenant that comes along. It's having your standard operating procedure as far as what their income needs to be, their background as far as having past issues with non-payment of rents, and all of that's available now through systems that the real estate professionals can utilize. So when we're looking at all four of these or five of these, knowing your market, then your acquisition, construction, leasing, property management, it's having a plan in place that you stick with and you execute on. And if you're doing those things right, you should have success.
Yeah, and kind of leads to that last point there of being professional. If you're doing all that and you're running this like a business, then you should certainly have success. And not that it doesn't take time to understand certain things, and you live and you learn. But I think when it comes to finding success in affordable housing, being professional on every single level, especially when you're dealing with tenants, and being aggressive on the property management side, taking care of issues as they come up, treating tenants the way that you want to be treated is going to lead to success. Obviously, that's not the be all end all and things happen, but it's certainly a good way to operate, from a holistic standpoint. So we kind of talked on a lot of these, but just to kind of to overview them again, these are some of the top misconceptions around investing in affordable housing. So lack of profitability, as we stated before, the Nuveen research was showing over the last 20 years, affordable housing tend to be more profitable than any other real estate sector. And a lot of that had to do with the stuff we were talking about with the demand, the government subsidies, the resiliency during recession, those kinds of factors. The quality and maintenance concerns kind of goes off of what Ron was just talking about. I mean, a lot of that just comes down to your procedures and, your being professional from a landlording perspective, and to buying right. If you can go in, if you're buying correctly on the purchase side and you can renovate and do a good job with those renovations, it's going to lead to less maintenance requests and issues down the line. High risk of non-payment comes back to, it comes back to screening and property management. But also if you have a certain portion of your portfolio that is subsidized, that's certainly going to help with that. Complex government regulations. Ron, what's your thoughts on that? How difficult is it navigating the Section 8? And it's not just Section 8 vouchers either. There's other programs that are available. I think if you put a little time into it, people can certainly learn and understand how to navigate that space. And when it comes to applications and inspections and stuff like that, would you agree?
Absolutely. There's a lot of information available as far beyond Section 8 for nonprofits that provide housing assistance. And, you know, like with anything else in this process of investing, doing your upfront work and research saves you a lot of headaches down the line. You know, there is definitely a process to obtaining Section 8 tenants and being in compliance, but it's nothing overly complicated. It's just knowing what you have to do and doing it. And if you do that, it's a relatively easy process. But again, it's just knowing up front what the requirements are, understanding them, and implementing them.
Okay. Limited tenant demand. As we discussed, I don't think there's a sector in the real estate world that has more demand than affordable housing, workforce type housing does. Unattractive locations. So that's a huge misconception. And I think a lot of it comes down to, you know, what's your strategy? And I mean, like if you want to invest in affordable housing and you want to, you know, operate with with Section 8 subsidies and stuff like that, then these certain locations that some may say are unattractive are actually extremely attractive because the demand for those types of housing is extremely high in those areas. What would your comment be on the locations and people's concerns around locations when it comes to affordable housing, Ron?
Sure. I mean, really, you just kind of nailed it. You know, if there's a demand in an area, there's a reason for it. It's not necessarily just somebody looking for a home to live in. There has to be something in that market that's supporting a housing demand. As Peter mentioned earlier, a lot of the metropolitan areas that we're invested in have hospitals, and in multiple hospitals, and we tend to acquire around those hospitals. And the reason that we do that is there's a demand in those areas. You know, a need for jobs. A lot of these Section 8 tenants or subsidized housing tenants, there's another misconception that they're not employed. Most of them are employed. They're just having a tough time meeting the affordability of these different markets. So they need a little bit of help. So, you know, anytime if this was an area where nobody wanted to live or there was no reason for them to live, there wouldn't be demand. And we see this in a lot of cities. As you move further away from the business areas or the job markets where people are trying to live close by, that demand dries up, and that's where you'll see a lot of blighted areas. So there's reasons for that.
Yeah, and then inability to raise rents. Ron, speak to that. You know, I mean, I think that's a huge misconception. People think that with affordable housing, you can't raise rents, or, you know, your rent's going to be under market rent or something like that. Speak to that a little bit.
Yeah, I mean, you absolutely have the ability to raise rents. If you are producing a quality product that's going to meet the demand, you know, you absolutely will be able to raise rents. I mean, you go back to the information that Peter presented in the beginning, that we have a 7.3 million unit shortfall for affordable housing in the country. But one thing that note didn't mention was that we're only making up 100,000 units per year of that. And the majority of that demand is really the single family, not the multifamily. You have a lot of families that need 2, 3, and 4 bedroom homes to live in. And, you know, and for the most part, the subsidized multifamily housing doesn't really meet that demand. So if you're turning out a quality product, you're going to have the ability to raise rents. You can look back over the last 10 years and it's consistently gone up over that 10-year period. You know, even if you pull out the last few years, you know, some of that induced by the pandemic, that rental increase, you actually saw a more stable increase in the affordable housing space, specifically the subsidized housing space, because it is a little more controlled. You didn't have the hockey stick that you saw in some other single family markets. It was very consistent. It wasn't as volatile. And if you look historically at the subsidized housing market, affordable housing market, that's what you'll see. It's steady rent growth over a period of time. It's not up and down like you'll see in other markets over the last 10 or 15 years.
Good point. So let's hop into an active investors action plan to get started investing in affordable housing. One thing I said in the beginning was there's a lot of different opportunities within the space, whether you're a wholesaler, a fix and flip guy, you want rentals, you want single family, apartments, land. This was kind of built more towards building a rental portfolio, but I just want to be clear, there's a lot of different avenues to enter into the affordable housing space. I think there's an unbelievable demand, like Ron said, for single family affordable housing. A lot of, like I mentioned Nuveen because they had just acquired I don't think they said the value, but a massive affordable housing portfolio, mainly in throughout the mid-Atlantic, mainly in New York City. This was just a few months ago. Prior to that, Goldman Sachs and the Michaels organization had acquired a huge affordable housing portfolio that was throughout the country. The institutions are typically going after the large multifamily affordable housing complexes. There's a lot of opportunity in the single family space, and that's really where a lot of the demand lies. There's a lot of families in these income brackets that want to raise their family in a single family home, and there's a lot of benefits, obviously, to being in a single family home. So a lot of this we kind of covered in the other slide, but just to kind of run through it again. And Ron, maybe you can help me with this. This is an active investors action plan. So obviously it starts with learning your market, understanding the subsidy programs that are available. Like I said, it's not just Section 8. There's other local and community and type programs that are available too. You want to get your construction team in order, whether it's going to be you doing everything, whether you're going to be working with a general contractor or utilizing subs for certain things that need to get done. You want to start to get that in place. We talked about this before, interviewing leasing agents, sales agents, wholesalers. These are people that could bring you deals, but also help you find tenants or exit a property if you're looking to fix and flip. Lining up an experienced property manager. So if you're not going to be managing the property yourself, you want to work with somebody who hopefully has had some experience within the affordable housing space and knows how to manage, those types of properties and tenants. And then two, Ron had mentioned this before, you want to define your management process and your rental experience and, just kind of your overall internal operational guidelines. And that's going to come in handy when you go to create your business plan and when you go to start to talk to potential capital partners, investors, whether it be hard money, private lenders, friends and family. If you have those things in order, it's going to be easier for them to understand what your goals are, what your action plan is to achieve those goals, and just, how you're going to execute effectively. And Ron, feel free to elaborate on anything I'm saying here.
Or, anytime you're an active investor and, assuming we're not talking about a large corporation, you maybe you do this on the side, or maybe it's a new endeavor that's going to become a career. Talking about the areas where I see most people have the biggest issue, if they don't have a specific background in any of these in these different line items, let's assume you've acquired right and you understand the subsidy programs, or if it's a property that doesn't need a subsidy program. The first area where I see people have the biggest problem is the construction. If they're not experienced in that field, or they don't have the right resources from a construction management standpoint or general contractor, subcontractor, that's where I see the biggest issues. But if that is not the case, and that piece of the process, goes well, your next step is your leasing agents. And I think it's imperative that you have experienced leasing agents. I see a lot of people make the mistake of trying to rent things out by themselves without using a leasing agent and having that buffer. I think it's money well spent, especially if it's somebody who understands the market and can be a real asset for you, especially if you're trying to do this on any sort of scale. Property management, I see a lot of smaller investors handle the property management internally, and even though that's something that or individuals do it themselves, even though it's something you can certainly do, the majority of the stories I hear, even as somebody goes from 1 to 2 to 5 to 20 properties, it becomes a headache. And I think, again, it's important to have a buffer there. So an experienced property manager can be an incredible asset if you're trying to create any type of scale. And I go back to what we talked about earlier, is that your process is imperative. All of these things, if you have your process and you stay within that, or the model that you've created, you can have success. Obviously, if you're not understanding anybody's individual financial situations, but if you're trying to utilize other people's money or leverage, finding the right capital partners is huge. Especially if you're trying to do multiple projects, you want to have capital partners that are timely, that meet your needs, have good communication. So all these things are very important, especially again, if you're trying to scale.
Yeah, I think you bring up a good point there, Ron, because I think there's a misconception in single family investing is that, like, the larger the portfolio is, the more headaches there are. But I think you want the bigger the better when it comes to efficiencies. I mean, you want to get to a certain point where you can bring certain things in-house, whether it be construction or property management. And the larger you are, the more the ability you have to bring that in-house, which is going to actually lower the headaches at the end of the day. Because if you only have a couple properties and you have an issue, a plumbing issue or a roof issue or an electrical issue or something like that, and you have to call a third party to come out, you're not going to have a whole lot of leverage, and you're certainly going to be paying a premium on price. So I think there are certainly advantages when it comes to scale and having the efficiencies that are created and the cost savings that are created, the larger the portfolio is. Would you agree with that, Ron?
Absolutely.
And it kind of leads into the next one, which is a passive investors action plan. So there's opportunities in private lending, there's fund investing opportunities, and then there's another partnerships. And I mean, just having a partnership with somebody, where maybe you put the capital up and they do the work, something like that. So you want to seek out experienced investors or newbies too. You know what I mean? Like, because when you're in private lending and you're dealing with somebody who's a little bit on the new side, you could maybe justify a higher interest rate on the loan. So that's going to just depend for your risk tolerance and the amount of work you want to do when it comes into, analyzing and overseeing the deals that you're investing in. Ideally, you want to invest with somebody who specializes in, or they focus on affordable housing, so they understand the intricacies within the space and they know how to operate in these areas and with these types of tenants and with, the government programs and things like that. They have connections to maybe make things happen quicker and more efficiently. And then obviously, just do your due diligence and ask a ton of questions. I think that's really all you can do at the end of the day. That could questions involving the management team, their experience, their track record, their goals, what's their vision, what do they want to achieve, how are they structuring their deals, what's their model, their business plan, and then how are you going to communicate? How often are they going to get in touch with you when it comes to, just progress from the portfolio or in executing the plan? And then what level of transparency are they going to provide? And then obviously you have to make an investment. Make an investment with once you feel comfortable and you've done your due diligence, and then monitor that regularly. So, look at the reporting, look at the progress, and have, a continued regular conversation around all those things and the progress and what they're seeing in the market and stuff like that. And always keep an eye out too to see what else is going on and what other opportunities there are. And obviously you want to diversify. Is there anything you would add, Ron, for a passive investor's action plan to get started in affordable housing?
No, I think you nailed it.
Okay. So I wanted to give everybody like a little bit, we talked about numbers and stuff like that. So I wanted to give people an idea of the fund offerings that we have and the kind of returns that we project and we've been able to pay our investors over the years, to kind of give you an idea of why we invest in single family affordable housing. We talked a lot about the benefits and the impact, and just the overall, positives around the community and for individuals and stuff like that. Let's talk a little bit about the profit side and, and get to how, the returns that we offer in our funds and that we project. And this too, for active investors, would give you an idea of, maybe what's possible. But also obviously you want to take into consideration that each market's going to be a little different. So I'm going to dig into our model a little bit, and I'll do this real quick because I know we're pushing like 12:41, and I want to open up to questions as well. So as we said, our focus is single family rentals. We offer a growth fund and an income fund. The growth fund is essentially a 50-50 split between the management and the investors, with a 6% preferred return prior to the split. The average annual return to the investor, they should look at it from like a 5 to 7 year perspective, with opportunity to stay in longer than 7 years if they want it, opportunity to possibly get out prior to 5 years if they want it. But average annual return, when you're factoring in the preferred return, the 50% of the profit and the 50% of the equity, at a 5-year exit should be somewhere between 20 and 23%. The average annual cash yield should be around 8 to 11%. So that's the 6% preferred return plus the semi-annual profit splits. And the equity multiple, which factors in for us, it factors the preferred return, the cash received along the way, and their equity at exit, should be around 2.5 to 2.8. So compared to other investments, there is certainly, a benefit to investing in affordable housing when it comes from, profitability. In that type of a fund structure, there's going to be tax advantages for investors. So you're going to share in depreciation. You're going to, your equity would be taxed as a long-term capital gain. And then, the way that we do our reporting and financials is provided on a quarterly basis. And then we do financial calls typically within a week or two after those go out. Gives you time to review everything, and then we can have an open conversation around, what's in the financials, the progress, the market, all those kind of things, answer any questions. So our income fund, that's a little bit of a different structure. So instead of a profit sharing, equity sharing structure, it's a fixed rate of return for a fixed term. So if an investor invests for 1 year, they make a 9% preferred return, monthly distributions, 3 years, 10% monthly distributions, and 5 years, it's 12% with monthly distributions. Or as you can see on the screen, if you if you didn't need the monthly payments, you want to compound them, you can get a greater return that way. Same thing with financials and reporting. It's quarterly, and we hold management calls a week or two after they go out just to discuss everything. So that's a lot of numbers. I wanted to just take a minute. Like I said, I want to open it up for questions, but kind of take a minute to just look at the model and how we're coming up with those returns. And this will also give you a little window into the affordable housing, the types of properties we're talking about. So on a $5 million fundraise, you should end up with about 310 or so properties, and we'll get down to the unit count per year. But your purchase price for us is typically going to be around $70,000. with an average renovation cost of around 45,000. That could be reversed. I mean, so that's an average. I mean, like Ron said, we like to buy distressed properties as well, where we might buy them at $30,000 and then put 70, 80,000 into them. We're typically going to see an after repair value of around 185. But one thing you'll see with the way that we do our modeling is we do a sensitivity analysis. So we want to see, you know, what are the actual numbers look like? So what have we been able to achieve over the last couple years? And on average, our purchase price and renovation costs are usually closer to 100,000, but we increase that just to be conservative. And our after repair value is usually going to be closer to 185, but we decrease that just to also be conservative. So we put 160 in. We have a loan to value at 75%. An occupancy rate at 95, so that gives you a 5% vacancy. That's a lot higher than what your vacancy rate is normally going to be in affordable housing. I think historically, what is it, Ron? It's usually closer to like 2% historically. If you
Well,
look at the data.
2% if you combine single family and multifamily, and right now 75% of that is multifamily. So it's significantly less than 2%.
Sure. And that speaks to just the overall demand in the space. Average rental rate, we put in $1,475 a month. That's typically closer to around $1,650. So just to be conservative, we put it in at $1,475. Property tax at 0.6%, insurance insurance at 0.5%. A lot of people think sometimes, you know, your standard, you put 1%. These numbers are actually a little bit high. Ron, what's our average tax, average insurance? Usually around
Our
$500 to
average
$800.
tax is about 0.4, and the insurance is a little bit lower than that. I mean, we again, Peter said, as Peter noted, we stressed our actuals in a sensitivity analysis. So these are a little bit higher than our actual numbers. The property taxes are almost double in this model. They're actually
In this model, yeah.
they're really probably about 0.3.
Yeah. So the maintenance, same thing. We put it higher because typically you're going to see affordable housing maintenance being a little higher. For us, it's the actual number is definitely lower than 7%, but a lot of that has to do with, you know, buying right and like Ron said, being able to go in and fully redevelop. That definitely just leads to less maintenance requests and needs over the course of a rental. We put a refinance every 12 months, which typically we would like to refinance at least twice a year, hopefully more than that. And that's going to be at a 7.25, which for us is we're usually closer to 6.25, and we've stress tested this all the way up to 10. So just to be conservative. So just to give you an idea, with $5 million raise, refinancing once a year, you're buying anywhere between 41 to 48 properties a year. And the portfolio value is ending portfolio with cash is about 61 million. Portfolio equity is about 22 million. So to give you an idea, this kind of breaks out the return investors receive in the growth fund, with the average annual return of 20.56. It breaks out the preferred return, the profit split, the total cash yield. I could share this information with anyone. Like I said, I want to make sure we leave time for questions, so I don't want to spend too much time looking at it. But just to reiterate, you don't need to invest in a fund to invest in affordable housing, and you don't need to go out and raise $5 million to start investing with affordable housing. You know, with $150,000 beginning investment, and just buying one property a year, at the end of 7 years, you have 7 properties. Your portfolio equity is almost $700,000. Your average annual return is over 19%. Your equity multiple is 3.4 times your initial investment. So there's a lot of return to be made. And as you could see before, the more capital you can raise, the more properties you can buy, the more equity you can create, the more you can refinance, and the higher your return will be. And like I said before, there's a lot of efficiencies to scaling a single family portfolio, so that you can bring certain aspects in-house and have, have more leverage when you're dealing with third-party contractors and subs and things like that. So, okay, we talked about a lot. Let's open the floor up to questions. We're happy to answer any and all questions. And my contact information is on the screen there. If you have any questions or you'd like to dig deeper on anything we discussed today, always feel free to reach out to me. You can schedule time with us on our website, gsprei.com. And just for anyone who's listening, it's my phone number, 610-357-2330, and the email is pneil, N-E-I-L-L, @gsprei.com. All right, let's open it up.
Perfect. Thanks, Peter. Thank you, Ron. A lot of great information there, a lot to chew on. We do have a few questions that have already come in. A reminder, now is the time to put your questions in the chat in the Q&A section. So start typing now. But in the meantime, first question is more geared to IRAs. Can someone take advantage of tax credits in a retirement account? That answer I don't have off the top of my head. That's a good question. You can either email me and I'll get an answer, or you can always check with your tax professional as well. So sorry, I don't have an answer.
Will,
for
I
that.
can kind of add to that just from the experience we have with investors who invest through their IRA. So the growth fund, the way that that's structured with the profit and equity sharing and the use of leverage, chances are that would draw up a U-bit in an IRA account. Now, some people don't care. They think the return's worth it compared to investing in the income fund for a fixed rate. But the income fund, our CPA's opinion is that it does not draw up a U-bit. So a lot of people like that option for their IRA. But when it comes to other tax advantages in the IRA, I don't think they would necessarily share in like depreciation and stuff like that.
Thank you for that. Next question we have comes in. How many properties are in your current portfolio?
So combined our portfolio, so we have the rental portfolio and then the loan portfolio. We have about 100 rentals, managing about 420 loans right now, with a combined assets under management about 55 million.
Okay. Thank you for that. Thank you for the question. Another question, actually, the next two questions are kind of in the same vein. Which specific markets are you invested in, investing in affordable housing, and where is GSP REI focused geographically?
Sure. So our office is in Paoli, Pennsylvania. The markets that we invest in is Philadelphia and the surrounding suburbs, Baltimore, and parts of South Jersey. So we really like Baltimore for a lot of different reasons. Ron knows Baltimore well. He went to school in Maryland. So being that we do all of our construction and property management in-house, and we're a little bit of control freaks when it comes to the construction and property management, we want to operate in areas that are geographically close to us so that we can have our boots on the ground, and our crews on site and be able to, retain full control over the budget and the time frame on our projects. Ron, maybe you can elaborate a little bit.
Yeah, no, I mean, Peter really kind of said it all there. I mean, one of the biggest drivers to the success we've had is the ability to look, touch, and feel throughout the whole process. It's not to say that we wouldn't entertain other markets, but right now the demand in the surrounding areas is so high, we don't feel like we really need to go outside of these markets. And as Peter mentioned, Baltimore has been a big focus of ours over the last 18 months. We're having a lot of success there, and we see a lot more attention being focused on that market over the next couple of years. But our primary reason right now is we want to control everything that we're working on, from the construction to the property management. We just want to be hands-on. We found that's the best way to have success and eliminate risk and problems.
Great. Thanks for the questions. Thanks for the answer, of course. If anybody has any more questions, please put them in the chat now. But question I have, I know you gave an action plan for different types of investors, but if somebody were finishing up this webinar or this recording right now, which would be the next step you would say would be best to best for them to continue down this avenue?
Sure. So I'm always available for, one-on-one call. Ron is too, Wade, our other partner. So I would say go over to gsbrei.com. It's on the contact us page. You can schedule a call with us. This way we can really dive in deep and better understand your situation. And we have a bunch of resources on there, from company webinars and podcasts and things like that, where we've gone into different aspects of our business in more detail. So you can certainly poke around on there and get more resources and a better understanding of us and our track record and our mindset and things like that. We do have a company webinar that's going to be launching towards the end of August. That will be a weekly webinar where we will talk about single family investing. I mean, and a lot of that obviously will be in the affordable housing space, but just single family as a whole. I think there's an unbelievable opportunity in the single family space moving forward. So, there's that. You can connect with us there. But I would say, don't be a stranger. I mean, feel free to call me anytime on my cell phone there, text me. We could set something up and, just help me to better understand your situation, and I can see how we can help you, whether you're active or passive or just getting started or looking to add, single family or affordable housing to your portfolio.
Thank you. Thank you. Another question actually just came in. Has the doubling of long-term interest rates affected your acquisition and construction efforts over the last year or so? Are you seeing any strain on your tenant base due to increased inflation?
You want me to
Yeah,
get that, Peter?
Yeah. So, the rise in interest rates was something that we accounted for from day one within our model. And I mean, like I said, we always run it through a sensitivity analysis. So we want to see, that was something I went to, I don't know if you guys know Jim Bennett from Stonehenge Funding. I went to a Delco property investor meeting back when I was first getting started, and he went over everything. And one of the big things was a sensitivity analysis on interest rates and things like that. So that's always been a foundational thing for me, is to look at interest rates and the effect on rising interest rates. One thing too is rents typically will correlate with interest rates. So we've seen increases in our rents along with increases in the interest rate. So it's something that we certainly account for. And in our model, we've gone, we can still hit our returns upwards of a 10% interest rate. One thing too, that's a positive towards the single family side and the way that we finance our properties. Usually we're using cash up front. So we're purchasing and renovating through cash, and then doing a portfolio refinance on the back end to get the capital out of the property. The interest rates on those are typically 30-year fixed. So recently we have certainly kind of slowed down on our refinances. We have 2 in the works though. It's not like we halted them all together. So ideally we would like to refi at the lowest interest rate humanly possible, because it is 30-year fixed, but we always have the ability to refi later on down the line. But having a 30-year fixed interest rate certainly comes with certain benefits. So anything to add there, Ron? Or?
Yeah, I mean, a couple of things. I mean, we talk about the increase in interest rates. I mean, over the past 2.5 years, we've had portfolio refinances from anywhere from 4.25% up to 6.2%, and our current portfolio refinance is at 6.2%. As Peter mentioned, we stress this far above 7.25%, which is in the model. But one thing that people are not talking about as much now, obviously what we do has a heavy focus on construction and materials. During the pandemic and in the time, after that, or in the months after, building material costs were significantly higher. They've actually come down in a lot of areas. So, where you're experiencing some rise in other areas with interest rates, you are seeing other things leveling out. So it's a little bit of a balancing effect. And as far as, the impact inflation has had on our tenants, when it comes to our subsidized housing tenants, that's not as big of a factor, because they're HUD or whatever program we're using has a pretty strict criteria when they're looking at what is the affordable piece for the tenant. So when they're, we'll use Baltimore as an example, they submit something that's called a RAFTA. And in that RAFTA, they have a lot of information about the amount of money they make, utilities. So many things are taken into consideration, the cost of utilities, things that you wouldn't even think of. So when they come up with a formula of what the tenant's going to pay and what the government's going to pay, and most likely, or in most cases with our tenants, at most we have tenants paying 20% of the rent. It's affordable. We haven't seen a big impact from that standpoint. We do have some tenants that fall into that workforce housing category who are not subsidized housing tenants. And again, we're very stringent about our screening process and we look at their jobs, what their job is in a sustainable market. Is it a W-2 employee versus a 1099? We look at reserves. We look at a lot of things. It's not a perfect process. At the end of the day, life does come into play, but we do everything we can to mitigate that risk. Overall, we haven't seen a very big impact as far as inflation is concerned on our tenants, but sure, a few of them have felt that. And what we encourage right from the very start, and this goes back to your process, we encourage communication. If there's an issue, please get out in front of it with us, and we're going to work with you so we can avoid any negative impact on our property, on the tenant, just as a whole. So, if you get out in front of these things, 9 out of 10 times you're going to be able to work through it. And, and that's, again, it goes back to part of the process. Nothing ever goes perfect, especially when you're working at scale. But if you stick to your process, things usually turn out okay.
Great. Thanks for both of your answers. We do have one more question, and I think that'll be the last question for the day. And then we can wrap it up. $45,000 construction. Are these full gut renovations or light renovations?
So I'll touch on that. I know when Peter showed the model, yes, that shows 45 and 70 for the acquisition. When I was talking earlier, I mentioned that we like to do full renovations. We do have a blend. Our blended number is 115 all in on the model, acquisition and construction. That could be a $15,000 acquisition and $100,000 construction, or the reverse. Our preference is the former, the $15,000 acquisition, the $100,000 renovation, because everything is brand new at that point. And we can project out, historically, when we've done that, or when that's the path we choose, we have a lot less issues from a maintenance standpoint. Any house that we buy, we're going in and doing all the necessary renovations, but if it's not a full renovation, obviously everything's not brand new. So the majority of our portfolio leans towards the full renovations. Those are put in there just for acquisition, to come up with a blended number. It's not a defined buy and renovation every time. That's a blended number.
All right, thank you for that, and I want to thank you, Peter and Ron, for the time you took presenting this information to us. I want to thank everybody who came out and viewed this, everybody watching this in the future. If you have anything that you want to leave the viewers off with, Peter or Ron, now would be a perfect time.
No, just thank you for coming. Thank you for taking the time to listen to us. And like I said, feel free to reach out if you have any questions. Always here to help and see how we can help you in any way possible. So no, I appreciate you being here.
Yes, we appreciate the time and listening to us.
All right. Thank you all. Thank you for your time. And I hope everybody has a great rest of their day.
You do the same.
Thank you.
Thanks.